On Monday, the 18th of May, something shocking happened in the crypto market. US spot Bitcoin ETFs recorded a massive $648 million outflow in just one trading session. That became the biggest single-day withdrawal since January, pushing total ETF outflows beyond $1.5 billion in less than 2 weeks. But here's where things get strange. During the exact same period, Michael Saylor's strategy company purchased another 24,869 BTC worth almost $2 billion. At the same time, the Clarity Act successfully passed through the Senate Banking Committee with a 15-9 vote, while crypto sentiment across the market stayed strongly bullish. So if the news was positive, why is Bitcoin falling? Bitcoin has now dropped 6.5% from its May 10th high of $82,200. And every recovery attempt below $80,000 keeps failing. Now this is where the real story begins.
Almost every major data signal right now, ETF flows, order flow, options market activity, and on-chain distribution is pointing in the exact same direction. And while retail investors are getting distracted by bullish headlines, professional money appears to be doing something completely different behind the scenes. Today we're going to break down the exact institutional signals moving this market, explain why the adoption narrative is clashing with the real flow data, and reveal the key levels and triggers that could decide Bitcoin's next major move over the coming 2 weeks. My name is Guy, and this is the Coin Bureau. Bitcoin reached its local high of $82,200 on May 10th, right after excitement around the Clarity Act peaked. But the momentum disappeared almost instantly. By May 12th, Bitcoin had already fallen below $80,500. By May 19th, it closed near $76,740, sitting around 5.5% below the 200-day moving average. The 14-day RSI currently stands at 44.3. That's not oversold. It's neutral, moving toward bearish territory. And that tells us something important. This is not panic selling. This is a slow, controlled, continuous bleed lower. And historically, this type of price action usually happens because of one of two things. Either large institutions are distributing heavily, or the market is repricing because of macroeconomic pressure. Right now, Bitcoin appears to be dealing with both at the same time. Let's start with the ETF situation. Since May 7th, US spot Bitcoin ETFs have lost more than $1.50 billion. Monday's huge $648 million outflow was led by BlackRock's IBIT, which alone saw $448 million leave the fund. That marked the second largest daily redemption of the entire year. ARK's IARK-B lost another $19 million, while Fidelity's FBTC saw $63 million in outflows during the same session. Even more concerning, the week between May 11th and May 15th produced over $1.04 billion in net outflows. And here's the key point most people are missing. The massive 6-week ETF inflow streak that brought in around $3.44 billion earlier in May has now been completely erased. Retail traders are not moving $448 million out of a single ETF in one day. Institutions are. That means professional capital saw all the bullish headlines and decided to sell anyway. Many people assumed the institutions buying IBIT earlier this year were long-term believers. But a large portion of that money was likely tactical positioning, not permanent conviction. And once macro pressure increased, that money quickly exited the market. Yes, total ETF inflows since launch still remain above $57 billion, so the bigger adoption trend is still alive. But short-term price action depends on the marginal buyer and seller. And right now the seller is winning. The order flow data confirms it. Cumulative volume delta, also known as CVD, has turned aggressively negative across both spot and perpetual futures markets. Spot CVD shifted from positive $16.90 million to negative $126.20 million during the recent drop. At the same time, two separate sell volume spikes above $1 billion forced Bitcoin below $77,000. Sellers are attacking bids directly and removing liquidity from the market. Meanwhile, the options market is flashing the same warning signs. The 25 delta put skew jumped from 10.9% to 14.4%, showing traders are suddenly paying much more for downside protection. And when separate data sets from completely different markets start turning bearish together, it usually means professional traders are positioning in the same direction with serious money involved. Now let's talk about the most important levels on the chart. First, the 200-day moving average at $81,267. That level has now flipped from support into resistance. Until Bitcoin closes above it on a daily time frame, the market structure remains bearish. Next is immediate support at $76,000. Bitcoin is testing that area right now. If price closes cleanly below it, the next major demand zone sits between $74,000 and $75,000. And that zone matters for one huge reason. Strategy's average Bitcoin purchase price across its 843,738 BTC holdings is roughly $75,700. If Bitcoin stays below that level for a sustained period, the largest corporate Bitcoin holder in the world would officially be underwater. Even more interesting, Michael Saylor recently admitted during the Q1 earnings call that Strategy could potentially sell Bitcoin if necessary to handle dividend obligations or balance sheet pressure. That changes everything. For years, the market viewed Strategy as a permanent buyer, but now, for the first time, investors are questioning whether that assumption is still true. If Bitcoin loses $74,000, the next downside targets become $72,000, then $70,000, and in a deeper correction scenario, analysts like Material Indicators and Ali Martinez are watching $68,000. But there is still a bullish recovery path. If Bitcoin closes back above $78,500 on the daily chart, this current move could become a false breakdown. A sustained move above $80,000 and then $82,000 would completely weaken the bearish setup and shift momentum back toward the bulls. Now, before we continue, if you're trading crypto, gold, or commodities during these volatile market conditions, BitGet has launched its trading platform, allowing users to trade assets like gold and commodities directly with USDT. The platform offers deep liquidity, lower slippage, and leverage of up to 500x. Users signing up through the QR code or the link in the description can receive bonuses up to $50,000. Plus, traders completing a first net deposit of $5,000 and placing their first trade can unlock a VIP 3 trial, including fee discounts, special perks, and token airdrops. Now let's move into the on-chain data, because this reveals who is really moving the market right now. Two signals stand out immediately. First, exchange reserves increased by around 20,000 BTC since May 11th. That adds approximately $1.53 billion worth of possible sell pressure onto exchanges. At the same time, short-term holder loss to exchange volume surged to 10,200 BTC, marking the highest reading since March 27th. That means newer investors are sending losing positions onto exchanges, classic capitulation behavior. But there's another important piece. Long-term holders have also been selling into strength. According to Glassnode data, realized profits exploded to 14,600 BTC on May 4th, the highest level since December. Long-term holders were reportedly taking nearly $180 million in profit per day, while Bitcoin traded above $82,000. There is one bullish signal though. Wallets holding at least 100 BTC increased from around 18,200 last summer to over 20,200 today. Whales are still accumulating quietly. But in the short term, selling pressure from long-term holders combined with capitulation from newer investors is currently dominating market flows. And all of this is happening while the macroeconomic environment continues getting worse for Bitcoin. The 30-year Treasury yield has now crossed 5%, reaching its highest level since July 2007. The 10-year Treasury yield sits at 4.61%. The S&P 500 dropped 11.45% during the week. Gold climbed toward record highs near $4,538 per ounce, while WTI crude oil rose to $14 per barrel, gaining 3.34% on the week, because of rising US-Iran tensions and instability around the Strait of Hormuz. Meanwhile, April CPI came in at 3.8%, while PPI printed at 6%. Because of this, CME FedWatch now shows markets pricing in nearly equal odds of a rate hike by December, a complete reversal from earlier expectations of rate cuts. And here's another major problem for Bitcoin. Its 30-day correlation with the Nasdaq has climbed above 0.7. That means Bitcoin is currently trading more like a high-risk tech stock rather than the independent safe haven asset many investors expected it to be. Gold is near all-time highs. Bitcoin is down 6.5%, yet both are supposed to act as stores of value. That divergence is sending a very clear warning signal. At the core of this entire situation is one thing: liquidity. Michael Saylor buying Bitcoin, the Clarity Act advancing, and bullish crypto sentiment are all positive long-term developments. But none of those factors are driving price action today. The real driver is macro pressure: higher treasury yields, rising inflation, oil shocks, and institutions reducing risk exposure are all hitting the market at once. Even though Strategy bought 24,869 BTC in a single week, it still wasn't enough to offset $1.50 billion in ETF outflows during this macro repricing event. And that reveals the uncomfortable truth many retail traders still haven't fully understood. During bullish periods, retail investors buy the story while institutions support the market underneath. But during stressful periods, institutions often exit first, and the narrative becomes the tool used to sell into retail demand. Now here's what you should watch closely over the next 2 weeks. First, monitor daily ETF flow data on Farside or SOSO Value. If ETFs suddenly return to 3 to 5 straight days of inflows above $100 million, that would strongly suggest institutional buyers are returning. Second, Watch the $75,500 to $76,000 range carefully on daily closes, not temporary wicks. If Bitcoin holds that area, the correction narrative weakens. But if it breaks, the path towards $74,000 and potentially $72,000 opens quickly. Third, monitor the 30-year Treasury yield. If yields fall back below 5%, pressure on risk assets could ease significantly. But if yields continue rising toward 5.3%, market conditions may deteriorate even further. Fourth, pay attention to CVD on spot exchanges. The moment buyers begin aggressively lifting offers again, instead of sellers smashing bids, that could become the earliest signal of a local bottom before price fully confirms it. So now the big question is this: is Bitcoin starting a deeper correction back toward the low $70,000 region as macro pressure forces another major reset? Or is this simply the final shakeout before ETF flows stabilize, weak hands capitulate, and Bitcoin begins its next major rally? Tell us what you think in the comments below. Thank you so much for watching, and we'll see you again very soon. This is Guy, signing out.